Morning, ladies and gents. Simon Brown here. Just want to check that everyone is receiving me, can hear me, can see my screen. We get yays to both. If you can raise your digital hand. Brilliant. I see hands coming aplenty. So this morning, what we're looking at is on our Talking Stocks Wednesday, we're looking around local ESG ETFs. Satrix released two of these a couple of weeks back, actually about a month ago. I think it was around mid-September when these came out. So they've been trading for a little bit. We'll touch on some of what the ESG is and then the specifics of the two ESG funds from Satrix. You got questions, drop them in the Q&A box. We've certainly got time to take the questions. And we'll pick those up. If they're not specific to the exact point, we'll come to them at the end of the presentation. Otherwise, we'll deal with them as we go along. ESG, environmental, social, and governance, which has certainly become the new standard. There's a bunch of research out there that this is sort of the hot new space where money is flowing into from the investment, particularly in the collective investment scheme. Environmental is issues such as climate risks, your natural resource scarcity, pollution, waste, and the like. So, you know, in many senses, you think, oh, that's going to be your big polluters, a Sasol or a miner or something. But there is ways to offset, and we'll touch on some of that in a bit. Social metrics are obviously including labor issues, product liability, data security, stakeholders, and the like. And then governance is corporate governance behavior, board quality, diversity. In South Africa, we would look to the King Code of Conduct to give us some sense on the governance, to get a sense of it. So really what it's saying, and we've kind of had these sort of standards before under different guises in a sense, but as ESG, they sort of come together as that singular sort of focus on the environment, on the social impact, and on the governance of companies. And what in essence ESG is trying to do, and I'm going to come back to this in more detail in a moment, is it's trying to say, excuse me, how do we measure this? What bits are important? What doesn't matter? You know, for example, Sasol, their pollution at the Secunda plant, if they buy carbon credits, does that offset? You know, does that then say, well, you are polluting, but you're buying the carbon credits, so that offsets it, and that's not a problem. You know, issues such as effectiveness of a board is really, really deeply subjective. Stakeholder opposition. Sometimes that's quite an easy thing to see, other times not. You know, product liability. Yeah, sure. You know, if you're selling motor cars, we can get a sense of product liability. But if you sold a widget that seemed innocuous, well, you know, go back to what was the water in the 80s, that some of them had glass in it. You know, you wouldn't normally think that was a product with liability. Perrier, there we go. Thank you, Susan. Perrier water, which was at that point only really bottled water in the world. Only really the very rich drank it, and then suddenly some of them had glass in it. That's suddenly a product liability that one wouldn't have thought of. You know, it wasn't intuitive. So I think it's important to understand that ESG is a lot of concept, and there needs to be a lot of standardization around it. I'm going to talk about that in a second. A lot of it is concept, and we're still kind of working out exactly how it works. The theory is that you get better returns. Higher ESG scores result in better profitability because they result in better companies. They result in companies that have better boards, more diversity, who are engaging labor and stakeholders, who are cognizant of issues such as climate, natural resources, those sort of things. So, broadly just a better run company, and therefore in an ideal world, a more profitable company. Now, there is a bunch of research out there which says, yeah, I mean, companies that score high on the ESG scores do indeed get slightly better levels of profitability. And let's be clear here. It's not, shooting it out the park. It doesn't make them twice as profitable or 50% or something. Most of the research I've seen has said that, a median basket of ESG compliant companies versus a bunch of peers who are not ESG compliant, you get a couple of percentage points in terms of uplift. But, if there's a couple of percentage points to be made in better profitability, and ultimately that will reflect in share prices and dividends, then you absolutely want this. And one of the first companies to really sort of embrace ESG was Unilever. And if you go to the Googles and look for Unilever ESG, you will see a company that is considered to be a standard bearer in the ESG space. And certainly if you look at returns, profitability, and the like, certainly has outperformed many of its tiers. They are, if in the right product, they are available and allowable within a tax-free environment. In South Africa, we've got, as I said, the 2 ETFs that have just come. There are some other collective investment schemes, unit trusts in the space, but there's not much. I mean, globally, ESG, I've seen reports, and again, it depends how you're defining the ESGs and the like, but there certainly has been a massive inflow into ESG in the last couple of years. In South Africa, we haven't seen that, largely due to not much. I mean, earlier this year, a couple of months ago, Old Mutual launched an ESG unit trust, which they touted as the first. I have no idea if it was or wasn't, but certainly they had reason to think that it was, which indicates that in South Africa we haven't had much here. Your risks are that it becomes a box ticking exercise. In other words, rather than actually being a proper part of the culture, and rather than it actually properly making enhanced profit, it just becomes well, we need to tick this box. We need diversity. Find me a certain type of person for our board, or whatever the case may be. There is a lack of standardization, and that is a real issue in this space. And I suspect, ESG in of itself is relatively new, and I know that there are moves afoot to try and get standardization working more effectively within the ESG space. At this point, it isn't yet there. And particularly, it's a phrase which gets thrown around, but if you said to me, and for this webcast, I'm like, let me go find, what are those boxes to tick? And it's practically impossible, because all the different index providers have their own methodologies. And yes, there is a large amount of overlap in their methodologies, but it's still, ultimately just that lack of standardization, and how it will work, etc. So that could improve over time. The question is how it's used. There's often a weighting factor. So, some stocks, some will say there was an Investec structured ESG structured product about July or so. And their methodology was quite simple. They used the ESG, and you had to get a score of about 40 to be included. Sometimes it's just weighting. So what they say is, well, if you've got a low ESG score, you will be weighted lowly in the index. In other words, as opposed to a market capitalization, they will say, if Naspers, for example, has a very low ESG, it wouldn't have the significance in the index. So you can see some shake up there as well. But that often, it means that you're not excluding perhaps poor ESG. And again, that comes back to standardization. You get some oddities, you get some concentration. Netbank launched a green ETF 10 odd years ago to 12 years ago. It was then taken over by Core Shares. It's subsequently been shut down. And it was our first and only green ETF in South Africa until these two popped out. And it was pretty much exclusively mining. And it's weird, you think, well, mining, how's that possible? And the point is that because mining actually do a fair bit, particularly around the environmental part. They also do, essential collective bargaining. They do 3-year bargaining wage negotiations, etc. So an industry which, if I said green, mining would not be on top of your list. It might not even be on your list. And yet, oddly enough, green actually, by that metric that was being used at the time, there was it was predominantly mining stocks. Of course, there's also going to be duplication, so that's important. If you're buying, and it's one thing if you're going to say, well, I'm going to start buying the ESG ETFs, is understand what's in them. Now, let's say you were buying Ashburton 1200, and now you decide to start buying a global ESG ETF. And so you just basically switch. Well, that's fine. But if you're saying, well, let me add to this as well, then you're going to get that duplication. Now that happens across everything. If you went and bought the China ETF from Satrix, your duplication is 10%, which we have in our local Reg 28 funds via Naspers and our ETFs and the like. And now you've got more of it coming out from the China ETF. Ditto if you buy the S&P 500 and then you go and buy NASDAQ, you're going to be duplicating up on, for example, Apple. And so the list goes on. Duplication is the only way to cleanly avoid duplication is to buy sort of one standard global ETF and then leave the rest to their own devices. So there will be some duplication within those existing ETFs that we already hold. So two of them. The first is the Msci World ESG Enhanced ETF. Both of these Satrix are feeder funds, excuse me. So they're simply buying the Msci World. This is a total return, so dividends will be reinvested. You won't get dividends paid out. Target expense ratio 0.43, which is a little expensive, but there's a lot of extra layers of fees in terms of the ESG, and the code STX ESG. The US is making up about 2/3 of the fund, Japan 7.4%, UK just under 4%, Canada just over 3%. So broadly, it's in line with the typical MSCI Global Developed, which is the one, I think there's a Satrix and there's a Signia in this space as well. Tech is obviously your top holding, which again is compliant with what we see in the MSCI Developed World. Apple, Amazon, Facebook, Microsoft, Alphabet are the top 5 holdings. Now, immediately you see something like Facebook and you think to yourself, hang on a second, how do they fit into the ESG? Well, I mean, we can debate it, but it broadly, again, comes back to my earlier point around that standardization. That's what's important, and that's what matters most. But it does mean that if you're holding, I mean, any global fund, particularly if you're holding Nasdaq, if you're holding S&P 500, you've got that crossover. What you're going to find is slightly different weightings, and what you'll find to a larger degree is that you will find the sort of tail to be smaller. There's the complete component. What you do note is that they have broken up the EU into the individual components. So France, Germany, etc., Netherlands, and the other, rather than oftentimes it's a case of they just put the EU as a single large collective. When you start drilling into the EU, it does come in at around 10 or so percent, 11% or so for the EU. Yeah, which one it is, the iShares that they are using for their feeder. And then there's the MSCI Emerging Market Enhanced ETF. Again, feeder fund, but this one will pay dividends. Slightly higher TER at 0.46 and code STX EME. And what we're looking at here is a emerging market as distinct. Now, we've talked around this before. It's not directly emerging markets in this for the developed market one, but of course those companies, let's look at them, Apple, Facebook, Microsoft, Alphabet, Amazon, they are certainly making profits, and that depends on the direct funds. They're making profits within those various different emerging markets. I'm sitting here on an Apple Mac. That is Apple, which is technically considered a US fund and a US company rather, but it has got emerging market exposure. Here we have pure emerging market. China is your largest market, no surprise by that, followed by Taiwan and then South Korea. Big holders, Alibaba, there's Tencent again, Taiwan Semiconductor, Samsung, and even Naspers. Naspers comes in at 1.29%. So there's even a little bit of duplication there. Now, there's a lot. If you've already got the China ETF, and you now add this to it, that duplication and that concentration in China starts to become significant. Now, of course, you might be saying, well, yeah, I want China. I want more holding in China. This is important to me. China's the second biggest economy in the world, and yet, it takes up very, very small allocation into most of the global ETFs. We get a little bit here via Hong Kong, but what is Hong Kong? If I'm reading my colors right, Hong Kong is coming in at 1.03. So call it 1% in essence on the developed market. So you get a whole bunch more sitting here. It does give us, South Africa is lurking in there. Relatively small, just over 4%. There's some South Africa there, but it is, as I said, it's China, it's Taiwan, it's South Korea. India, there's a lot of attraction to India, and then sort of your BRICS, Brazil, South Africa. We've got Russia down there at just under 3%. So it is, notwithstanding the crossovers, what we do find is that there is a lot more in a lot more diversity in terms of just emerging market exposure than we get via a developed than we do get in this sort of environment here. So I think they're a great addition to our landscape. It is something I think we will start to see more and more of it. And I think what we're almost certainly seeing is that the different issuers out there have that they're very much seeing, so how is this ESG fund doing? Question coming through is, will we get a pure South Africa ESG? I think in time we will. As I said, we kind of had one before dominated by mining, but I think the metrics will be different this time. But make no mistake, the issuers, the non-Satrix issuers and Satrix will be seeing, well, how is this ETF doing? What's its performance like? But more importantly than just straight hold performance is the question around, well, how is it going to be gathering funds? How many people are investing into it? I think that's going to be hugely important. So nice addition. I think it's the start of something we will see a lot more coming in time. For now, it is the first available that we have here. So I'm getting messages coming galore. And then just a quick recap to last week. A couple of folks were asking if I was going to be looking at the ETNs that listed of Apple, Amazon, Alphabet, Coca-Cola, Facebook, McDonald's, Microsoft, Netflix, and Tesla. We did do a video on this last week's presentation. They are trading. If you go to YouTube and search Standard Online Share Trading, you will find it there. That was last week's video. Remember, Mondays we do Market Standard. We had technical issues this week. And next week I am on holiday. I will be at the beach. So there is no Monday or Wednesday next week as I take a week's leave, and then we'll be back for the final rush to the end of the year. Ladies and gents, we will park that there. I've hit my time. Let me just check if there's any further questions coming through. Question coming, am I swapping into these? I'm not. I mean, and I truthfully hadn't even given thought to it at this point. I buy the Ashburton 1200 as my offshore. I'm comfortable with it. I certainly like ESG, and if there was a South Africa ESG, I'd give it a long, hard look. At this point, it's something which probably in time, and probably what I'll do more than anything is rather than sell out and buy into, is just deploy new cash into it. The FANG ETN, no dividends, is a good idea to take a price also between Qs and Cs, which is the better. So Cs have the currency impact, Qs do not. Long term, the Cs are better because the rand will weaken. The Qs, no currency impact, which if the rand is strengthening is great, but over long term, we will see weakness in those. Why ETNs are not ADR or other vehicle? Well, in essence, an ETN is kind of an ADR, right? It's a derivative product. The distinction, and it's a good question, Gideon, and I didn't ask. I mean, when I spoke to Becky Mscr, why not ETFs, which physically hold the shares? I suspect that they're able to do it at a cheaper process by using derivative structures and the like. So ETNs don't physically have to hold in that sense. ADRs, which would be, I suppose, JDRs, I don't know, Keith McLachlan has been talking about these, would essentially be broadly the same sort of structure. Would you think the FANGs are a good bet over 5 years? Crystal ball out view? I mean, short answer, yes. I mean, they have some challenges. There's the antitrust investigation dropped by Congress at the beginning of the month. And I spoke to Henry Biddlecombe from Anchor on my MoneyWeb podcast around that. You can find that MoneyWeb now. Spoke to him on Monday. Subsequent to that, yesterday, they've actually put charges against Google. So there's certainly going to be some headwinds from a regulatory perspective, but these are giant companies. And what we've seen with the lockdown and resultant work from home and the like, which is a trend which didn't exist a year ago, but has suddenly arrived and is not going to suddenly disappear, even as the virus, we start getting vaccinated and the virus becomes less of a threat. That trend is there and it plays into them. So absolutely, and Netflix had a slightly rougher time, etc. They've certainly shot the lights out. The easy winners in that space probably Microsoft and Amazon, in my sense. Ladies and gents, we'll park that there. As I said, no hearing from me next week. I shall be on holiday. Carlo, absolute pleasure. But we'll be back, which will be November 2, and then we run through to 15 December, by which time it is then the end of the year, and now we finally get our year-end holidays. Ladies and gents, everyone have a good day further. Stay safe. Cheers all.